Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that's really popular, that has been performing really well over the last year and could be performing really well over the next few years to come. And that stock is ExxonMobil. And we can see over the last year, this stock is completely dominating, up 37%, almost 40% in the same year that the S&P 500 is down 8%. So they're completely dominating the rest of the market. And so in this video, I'm going to look into some of the recent news that's come out surrounding Exxon. I'm going to look into their financial statements to get a better look at their earnings growth. And then lastly, I'm going to figure out if they're trading at a good buying price from a value investing perspective by using a discounted cash flow model to figure out their intrinsic value per share. And as you'll see in this video, ExxonMobil is actually trading at a pretty good price based on some of the estimates that we're going to be using in this video. And so first and foremost, we can see right here in this news article, they point out that offshore oil is about to surge globally, essentially in all markets for all oil companies. We can see they talk about how oil executives love to talk about the energy transition and about technologies such as hydrogen and carbon capture, but most of them are doubling down on what they know best, which is oil. And basically spending on new offshore oil projects over the next 2 years is projected to soar to levels not seen in a decade. And in particular, right here in this paragraph, they point out that Europe's oil giants and America's oil giants have begun investing in everything from renewables to electric vehicle charging. But even though they're going to be pouring money into these areas over the next few decades, oil still remains their bread and butter and still the most profitable segment of their businesses. And lastly, right here, they point out that something interesting to keep in mind is that the world is still likely to consume large amounts of oil for decades to come, even if energy transition efforts gain steam, global crude oil demand and global crude oil demand begins to decline. It really won't make that much of a difference in the short term because our main energy consumption depends on using oil at the moment. And so a lot of the investments in the short term are going to be made by companies that are looking to identify fields that can produce low oil prices and outlast competitors in a shrinking market. So basically, a lot of these oil giants know that the oil market is going to basically be dead in the coming century. But until it is, they want to make sure that they are the last oil company to continue to produce oil for the world's energy supply. And the way they're doing that is by competing, trying to find the different areas where they could basically get oil out of the ground for the lowest cost possible and also in the cleanest way possible so that their company remains profitable the longest. Another thing to point out right here for ExxonMobil is that they recently expressed interest in building an oil plant essentially to produce as much as 18 million tons a year, which is bigger than their initial plans of 15.2 million tons per year. And this is going to be built in, I believe, Mozambique. And so it was initially shelved because of the fact that there was some violence in the area from Islamic State-linked insurgency. But because of a mix of local and foreign troops, the violence has mainly been contained. And so another reason why this is actually heavily incentivized at the moment is because investments in this plant would actually end up being a net benefit to the local government in the area because the export revenues from these oil projects by ExxonMobil would help them service their debt, which is including a $900 million Euro bond. So it's not only in ExxonMobil's interest because it's going to increase their profits, but it's also in the interest of the local government because it's going to help them produce more state revenues. And so right here, we can see their income statement comparing 2020, 2021, and 2022. We can see massive revenue growth here year over year from $285 billion to $413 billion for 2022. So that's an increase of 45% year over year. And if I scroll down here to their net income line item, we can see that net income from 2021 was $23 billion, or in 2022 was $23 billion, and in 2021 it was $23 billion, and in 2022 it was $55.7 billion. So that's an increase of 141% earnings growth year over year. So not only did their revenue increase 45%, but their cost of revenues increased at a slower rate than their revenue increased. And so as a result, their earnings ended up growing even faster than their revenues did. So right here we can see their balance sheet comparing December 31st, 2021 to December 31st, 2022. Total assets for December 2022 were $369 billion. Total liabilities are $166 billion, and total equity is $202 billion. We can see they reinvested earnings of $432 billion. So that is a ton of money reinvested. They're definitely enjoying a lot of excess profits at the moment, and they're taking advantage of that. And lastly, right here, we can see in their cash flow statement, their operating cash flow for 2022 was $76.6 billion, up from $48 billion in 2021. And then we can also see that their financing activities pretty much remained constant over the year, from $35 billion to $39 billion. But what they spent it on changed dramatically. We can see that in 2021, they mainly used their operating cash flow to reduce their short-term debt by spending almost $30 billion doing that. But in 2022, they didn't do that as much. Instead, they mainly prioritized reacquiring common stock at $15 billion here. And then in both years, they paid out around $15 billion of cash dividends. And so basically in 2022, they definitely prioritized returning value back to shareholders way more than they did in 2021, whereas in 2021, they mainly prioritized paying down their short-term debt. So a lot of value returned to shareholders, and that probably contributed to their stock increasing this much over the last year. So right here we can see a discounted cash flow model to figure out the intrinsic value per share for ExxonMobil. We can see Yahoo Finance is estimating they're going to grow at around 26% over the next 5 years. So I was conservative when I cut that in half to 13% over the next 5 years after that. They had around $58 billion of free cash flow for the most recent full year, a net debt position of around $17 billion after subtracting their cash, and around 4 billion shares outstanding. That puts their estimated intrinsic value per share at $474 per share, with a 50% margin of safety of $237 per share. It means that at the current share price, they're trading not only below intrinsic value, but below a 50% margin of safety if they are expected to continue to grow at these projected growth rates. So definitely pretty impressive buying opportunity for ExxonMobil at the moment. Then right here, I compared them to some of their competitors in the industry, Chevron and ConocoPhillips. We can see that in comparison, it looks like ConocoPhillips has the highest profit margins, 37% gross profit, beating out Exxon's 25%, and 23% net profit, beating out Exxon's 13%. Across the board, their PE ratios are basically the same. ConocoPhillips is trading at 6 times earnings, Exxon is trading at 7 times earnings. And then we can see in terms of dividend per share, Chevron pays the highest dividend at $5.68 per share. So if you wanted to do a competitor analysis here and figure out which company was the best, I'd probably give it to ConocoPhillips for their profit margins, but then give it to Chevron for their dividend payout here. And so lastly, I wanted to compare ExxonMobil to some of the companies we've looked at in past videos. We can see that we finally have another company that's trading way below intrinsic value per share here. Historically, it's mainly only been GE, Albertsons, ConocoPhillips, and Google, but now we can see ExxonMobil shot to the top of the list. Right now, they're trading at 0.24 times their intrinsic value per share here, since it's estimated to be $474 per share, and they're trading at $115 per share at the moment. So they're trading basically at 24% of their estimated intrinsic value. The other 5 companies on the list, Verizon, Accenture, Chevron, Adobe, and Lockheed Martin, are not trading below intrinsic value, but they are trading at a better share price to intrinsic value than the rest of the companies we've looked at, so they did make it onto the list. But ExxonMobil has shot to the top of the list here, so it's pretty impressive. In terms of growth rate, we can see ExxonMobil, according to Yahoo Finance, has the second highest projected growth rate over the next 5 years at 26%, ahead of Eli Lilly's 22%, but behind General Electric's 44%. In terms of profit margins, we saw that ExxonMobil has a 25% gross profit margin and a 13% net profit margin. So those profit margins aren't good enough to get them onto the tables for gross profitability and net profitability. Adobe is still holding the number 1 spot with gross profitability at 89% compared to all the companies we've looked at thus far. And then Microsoft, for all the companies we made a video about, They have the highest net profit margin at 36% here, but ExxonMobil wasn't able to make it onto the profitability tables. And then lastly, for stock performance over the last 5 years, we can see, we can see Tesla and AMD are still doing the best right here at 700% and 600%. And then the rest of the companies here are doing really well, but they're trailing in comparison to number 1 and number 2. ExxonMobil over the last 5 years returned 54%. Most of their growth has actually come over the last year here. So unfortunately, they do not make it onto the stock performance over the last 5-year table here. But all in all, comparing them to the other companies we've looked at, it looks like ExxonMobil is doing pretty well in terms of growth rate, and they're doing very well in terms of presenting a good buying opportunity at the current share price. But keep in mind, that's only considering that they're going to continue to grow at the growth rates they've been growing at. If they aren't able to maintain these growth rates, then their intrinsic value per share might be a little bit lower than it's currently estimated to be here with this discounted cash flow model. And then in terms of comparing them to their competitors, it looks like ConocoPhillips has the best profit margins in their industry, but Chevron has the best dividend here, as we can see from these 3 companies. So all in all, it looks like ExxonMobil is doing pretty good. They've definitely performed very well over the last year. Let me know in the comment section down below what you guys think of ExxonMobil. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.